Hedge fund star David Einhorn expects stocks to tumble and warns unchecked inflation risks a market meltdown. The stock market isn't exempt from the current economic turmoil, and it is one of the worst hits as stock prices tank. The S&P 500 year-to-date is down 19%, while the Dow Jones Industrial Average is down 12%. It's a tough time for investors and companies alike. As we weather through the storm, hedge fund manager and president of Greenlight Capital, David Einhorn, gives his opinion and predictions for the stock market. We look at his third-quarter letter to the client and his thoughts on government policy. Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So, before we get into today's videos, hit that subscribe button and turn on the post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching. Now, let's get into it. The bear market isn't ending anytime soon, according to David Einhorn, chairman of Greenlight Capital. His bearish stance has helped his company to return 17.7% in the first 9 months of 2022, compared to the S&P 500, which declined by 23.9% in the same period. This is good news for his investors, but he wouldn't be dropping his pessimistic view anytime soon. As long as official policy is to make the stock market go down so that people are less wealthy, so that they buy fewer things, so that prices stop going up, all while doing nothing about fiscal policy, we believe the correct posture is to be bearish on the stocks and bullish on inflation. He expects stock prices to fall further, and as the Feds work to crush inflation, he believes that they would also lower stock prices with their policies. Whether we are in a recession or not, it's clear that the Fed wants to deflate the stock market, he said in the letter. He thinks that the higher rates are discouraging investments. When interest rates are increased, it makes saving more lucrative and borrowing more expensive. People would have to pay more for every loan they take. The continued hike could lead to shortages in the housing sector as mortgage prices continue to rise. Other sectors also face these problems. The Fed is worsening inflation, the opposite effect to what they had hoped for. This makes it harder for firms as they spend more servicing loans and have less to pay shareholders, making investing less lucrative. As inflation persists, he worries about a market disaster in the future. There might be a currency sovereign debt crisis if the issue of rising inflation isn't solved quickly. The rising interest rates and inflation make it harder for poorer countries with debts in dollars to pay up. Also addressed was the issue of value stocks. The current economic situation has created a harsh environment for these stocks to thrive. A value stock is usually undervalued. They are mostly stocks of companies that are new but have great fundamentals and future potential. These companies have to fund business sometimes by taking loans from banks, and the current interest rate hikes aren't doing them much good. The higher rates translate to paying more for loans and having less to return to investors. The interest rate hike, according to him, isn't going to solve the problem of inflation. The constant hikes instead have the opposite effect. Using his jelly donuts analogy from Huffington Post in 2012, a jelly donut is a yummy mid-afternoon energy boost. 2 jelly donuts are an indulgent breakfast. 3 jelly donuts may induce a tummy ache. 6 jelly donuts? That's an eating disorder. 12 jelly donuts are fraternity pledge hazing. Jelly donuts in this case are interest rates. The relationship between inflation and interest rates is non-linear in his books. So, the increase in interest rates is not affecting inflation. Government spending. He believes government spending is undermining the effort of the central bank to reduce price increases. Some of the major triggers for the record-high inflation are near-zero interest rates, growing money supply, and carefree government spending in his books. Government spending increased in the years after the pandemic. Alongside monetary policy was the major trigger of inflation, the easy money era as he calls it. So, a combination of monetary and fiscal policy was responsible and should be employed in fighting the crisis. He wants the government to employ fiscal policies also, and not just monetary policies. To give a quick recap, fiscal policy is the use of government spending and taxation to regulate economic conditions. Unlike the monetary policy that stems from the central bank, fiscal policy stems from the government. He hopes that government spending would reduce, as this would help mop up the money in circulation. It isn't easy and usually takes time for the policy to achieve its aim, but it's necessary for this. What are your thoughts about the current situation of the stock market? How long do you think we'll be in a bear market?